I think it's a little bit reckless for central banks, who are meant to be the pillar of monetary policy, who are meant to be, you know, the guardians of the prudent guardians of the economy. I think they're acting a little bit recklessly, in my opinion. You know, and when you see where the bond markets are trading, when you see what's happening to asset prices, I'm not sure it's necessarily good longer term. It's leading to capital misallocation. You know, people are buying things not because, well, what's value? Anyway, value is all relative, but people are buying things at extremely low, when rates are extremely low, and when bond markets are at ridiculous levels. I mean, you've got bond markets in Switzerland at negative, you know, bond markets in Sweden. Sweden had their first issue of bonds at a negative rate the other day. Like, it's bizarre, you know, the monetary settings are bizarre at the moment. It's leading to capital misallocations.
And for you specifically, you said it's made things quite tricky as a asset manager, and you have a value bias, I think, from your investment.
Yep.
How is it influencing, or how is it impacting what you're doing from an investment perspective?
Well, it's difficult because a lot of shares are being, you know, boosted by this high liquidity, low rates, and you know, are trading at fairly high levels. They may go higher, by the way. You know, that's unfortunately what happens with booms and busts. You know, things go higher and lower than what people expect. And we're in one of those periods where asset prices are sort of floating up. They'll get to a level, I'm not sure, it's like a balloon, you know, it gets to a level, and then at a certain level it sort of, that's it. It comes down to where it should be. And that's where we are with a lot of shares. So one's got to be a bit cautious. Look, and again, I'm not trying to preach gloom, but it's time for caution. You've got to look at each company, each share price, and say, can it be justified? You know, when maybe next week, when people are not as, what's the word, there's not this frenzy, I guess, to buy. Can this share price hold up? You know, can you justify this share price perhaps when you don't have this frenzy in a month or 2 or 3 or whatever?
So a lot of people talk about the value that's on offer in equities relative to what's available in fixed interest, and we talked about some of those, you know, some of the bond market returns earlier. Does that relative valuation influence your perception of value? Look,
yes and no, I guess. I guess one's got to remember that rates in Japan have been 0 for 20 years, and they've had a bear market for 20 years. So low interest rates are not necessarily the panacea for markets to go up forever. So what we try to look at is we're looking at companies, you know, and thinking, what if the frenzied thinking of today, the buyers sort of yield-driven way of looking at companies is not here in a month or 2. How will this company, you know, can you justify today's share price? That's sort of what we're trying to look at. Obviously, every share price will be affected if interest rates turn, you know, but I guess what we're trying to do is find companies where, you know, there's things happening within the company that in the next year or 2 their earnings should be better. And so if you do get some sort of correction in the bond market, you know, those shares, sure, as I said, everything will correct, but these ones can recover in a year or 2. That's what we're looking for.